Tax havens are territories that combine banking secrecy with a policy of low tax liability in a stable political and economic environment. We have called them tax havens because they are generally located in offshore countries that offer ideal conditions for companies and individuals who want low taxes. Tax haven allows money laundering as well as tax evasion. There is a lot of corruption around these territories, so they are very closely controlled. The majority of tax havens are small islands such as Fiji, Panama, Samoa, Cayman Islands, and others. We find these territories in the Panama paper case that will be developed later.
In this part, I will talk about the history of tax havens. But before that, I will briefly recall what a tax haven is. Indeed, companies are taxed on their profits and households on their income. They can therefore seek to reduce the amount of their taxes by transferring their profits or income to a tax haven. To OECD, which is an international organization that carries out economic studies, it defines three criteria for a country to become a tax haven. First, a very low level of taxation for companies and individuals compared to other countries. Then, a lack of transparency on the way in which the taxes are calculated. And finally, a lack of cooperation from the country on the amounts of taxes declared and on the identities of the declarants. These laws are accompanied by bank secrecy, which guarantees the confidentiality of banking information for businesses and individuals, and legal secrecy, which allows company owners to remain anonymous. So, it has been since the second millennium before Jesus Christ that the first traders of ancient Greece already sent emissaries to certain ports so that sellers and buyers during a transaction meet at an agreed point to transport the goods and thus escape the already existing port taxes. Today we will speak of offshore operations. Tax havens then developed from the 17th century and multiplied with the expansion of trade and the intensification of capital exchanges during the first globalization. For example, New York business lawyers are convincing governors of small US states with budget problems to provide franchise rights to firms that have their headquarters there. But it was during the 1930s that the phenomenon intensified, since the British judge decided in 1929, following the crisis, that the tax system applied to multinational companies. It was then that the firm sought to escape it by inventing the fictitious residence. Since the early 1980s, the movement has not slowed down. In the first quarter of 2004, the Chinese Commerce Ministry warned that 20% of foreign direct investment in China came from the Virgin Islands, the Cayman Islands, and Samoa. Overall, in 1997, the amount of assets managed by 65 tax havens amounts to 4,497 billion euros, according to journalists from L'Expansion. 3 years later, the French daily Libération published a survey evaluating all funds placed in tax haven at nearly 6 trillion euros, with an increase of 12% per year. To conclude with my part, I will just talk about the biggest scandal about tax havens concerned the Panama Papers, which designate the leak of more than 11.5 million confidential documents from the Panamanian law firm. This document detail information on more than 214,000 offshore companies, as well as the names of the shareholders of these companies. Among them are politicians, billionaires, top athletes or celebrities, the heads of state of government of 6 countries like Saudi Arabia, Argentina, the United Arab Emirates, Iceland, the United Kingdom, or Ukraine. They are directly implicated by these revelations. While in the law of most countries, offshore companies are not in themselves illegal, they are used as front companies in tax evasion or money laundering, that is.
Main tax havens. There are different rankings of tax havens, and the main one is a European Union blacklist, officially the EU list of non-cooperative tax jurisdictions, which names specific countries in order to improve global tax governance and fair competition. The first country is American Samoa. American Samoa does not apply any automatic exchange of financial information, has not signed and ratified the OECD Multilateral Convention. The next country is Fiji, which is not a member of the Global Forum on Transparency and Exchange of Information for Tax Purposes and has harmful preferential tax regimes. The third country is the Independent Democratic Republic of Seychelles, which is a tax haven with a stable political system that offers one of the most attractive complete offshore formation packages. Low government fees, tax resident low tax, and non-resident tax-free structures. A growing matrix of tax treaties used for investment into other countries, and international trade zone.
Due to their very low tax rates, we can then wonder how the governments of these tax havens manage to raise enough money to finance different sectors, such as health and education. So we will see three different ways for these tax havens to make money. The first one is called custom and import duties. In opposition to what their name suggests, these tax havens have many taxes. Lost government revenue is initially replaced by taxes on most goods imported into the country called customs and import duties. These are indirect taxes applied to items before they are sold on the market. This has the effect of making local life more expensive. The second way for these tax havens to collect money is through company registration and renewal fees. Although most offshore financial centers do not impose corporate income taxes, their governments still benefit financially from the registration of thousands of companies in their jurisdiction. As these tax havens generally charge registration fees to all new business entities, these companies also have to pay annually to operate in these countries. It should also be noted that certain fees are imposed depending on the type of business activity the company will be carrying on. Typically, banks, mutual funds, and other financial services companies must pay an annual license fee to operate in this tax haven. The third way is called departure tax. Tax havens often have a very dynamic tourist industry, welcoming millions of visitors every year. This is why some countries introduce a departure tax. This tax is a charge levied on the person on leaving the country. To conclude, we see that there are different ways for this tax haven to generate money other than income tax, and that it will greatly affect the local cost of living.
These papers is the name given to a massive leak of documents that reveals how billionaires and multinationals from all over the world have used complex financial structures to hide wealth and move large amounts of money away from the tax authorities of the countries in which they reside or operate. The documentation was obtained by a German newspaper and shared with the International Consortium of Investigate Journalists. In total, almost 400 journalists from 67 countries have investigated the 1.4 terabytes of information received during 1 year. Among those who appear on the so-called Paradise Paper are from Queen Elizabeth II, United States Secretary of Commerce, Canadian Prime Minister Justin Trudeau, Will Ross, Trump's son-in-law, Lewis Hamilton, Shakira, Madonna, Colombian President Juan Manuel Santos, multinationals like Nike and Apple.
The creation of tax havens has become a key area of finance thanks to free transit, which has continuously attracted financial flows from the facilities offered by the latter. What is generically known as a tax haven covers a diverse and complex series of territories, countries, and institutions that offer the advantages of financial and operational secrecy in their commercial relations, reduced taxation, or, in some cases, the absence of income for companies and individuals. There are many tax havens such as American Samoa, Fiji, or the Independent Democratic Republic of Seychelles. These offshore financial centers offer freedom, services, and opportunities. Among these freedoms are the absence of exchange controls, the freedom to build up reserves, the freedom not to disclose information, the freedom not to pay a series of heavy taxes. Services include the bank's offerings to individuals or companies, global custody, investment fund management, administration of offshore companies and trusts, legal and accounting services, and stock exchange operations. The notion of freedoms shows very clearly that banks use offshore financial centers abroad to avoid the sometimes burdensome regulations from abroad. The creation of tax havens has become a key area of finance thanks to free transit, which has continuously attracted financial flows from the facilities offered by the latter. What is generically known as a tax haven covers a diverse and complex series of territories, countries, and institutions that offer the advantages of financial and operational secrecy in their commercial relations, reduced taxation, or, in some cases, the absence of income for companies and individuals. There are many tax havens such as American Samoa, Fiji, or the Independent Democratic Republic of Seychelles. These offshore financial centers offer freedom, services, and opportunities. Among these freedoms are the absence of exchange controls, the freedom to build up reserves, the freedom not to disclose information, the freedom not to pay a series of heavy taxes. Services include the bank's offerings to individuals or companies, global custody, investment fund management, administration of offshore companies and trusts, legal and accounting services, and stock exchange operations. The notion of freedoms shows very clearly that banks use offshore financial centers abroad to avoid the sometimes burdensome regulations from abroad.